Welcome, everyone, and thank you so much for listening in. Today, we're going to talk about using covered calls, which is the perfect strategy to use on top of a dividend growth investing strategy that we just talked about in the last episode. But before we get started, as a reminder, this is an educational show and should not be construed as personal financial advice. Full disclosure information is available at ototnow.com. Now, let's get started. So, the covered call strategy, it's very conservative and it involves a lot of math. So that might be a bridge too far for a podcast, but I'm going to give it a shot. And if you need to, you can always, if you want to see the slides that I'm talking from, you can always go to the YouTube channel On Time on Target and find them there. Or you can just go to Investopedia and Google or look up covered calls, and you will see the baseline strategy there as well. I like Investopedia. It's written at a pretty understandable level, kind of like the old USA Today. It's written kind of at the 8th grade reading level, so you should be able to understand it, most of us. So that's where you can get more information. But I'm going to talk about it today, and if nothing else, I will expose you to it if you're just learning, or if you think you know how it works, you can listen intently to what I say and confirm that you know how it works. So it's a very conservative strategy where you actually sell options, sell calls on positions you already own. And the reason you want to do this is you want to earn extra money on your portfolio. It's considered earning an extra dividend or two along the way. You also can use it as a hedge, even though primarily here I'm talking about how to make extra money on a portfolio, which is now looking at the income generation phase, or you're just kind of a conservative investor anyway. This is what you would want to it's the strategy you want to consider to supplement a long-term buy and hold, especially, and a dividend growth investing philosophy. So here's how a covered call works. You sell an option to generate a premium. So the word premium itself, and for those that talk to me a lot, know that I like to say, hey, whenever you buy an insurance contract, you are not getting what you're getting what you're paying for, but you're not getting the value of what you're spending. You are paying a premium. You are, in the term itself, not getting your money back from what you're paying, right? It still makes sense to do so and to pay that premium to transfer risk, which is what insurance does, but it's not in a positive EV, expected value situation for you. It is for the insurance company. And when they write, thousands upon hundred thousands of these contracts, not a single one do they sign their name on them without it being a positive expected value for the insurance company. Think of casinos. They don't put games out on the floor for you to play that aren't positive expected value for the house. They just wouldn't put them there, right? Same with insurance companies, not trying to say they're casinos. That's not the point. But from an expected value situation, anytime you buy insurance, you are not getting it's not a positive expected value situation. So let's go back to options and why it's called a premium. We are the sellers of options. That's the only thing I'm talking about here, is selling them. So in relating that to, people pay us to buy them and they pay a premium to do so. So what I love about this strategy is positive expected value from day one. You pull out the piece of paper. It's not actually a piece of paper, but conceptually you think, you pull out a piece of paper, you pick the strike price, you pick the stock, you pick the number of shares, you determine the premium that's worth for you to sell, and you hang it out there on the open market. If it's too high, nobody buys it. If it's too low, people snap it up. So you tend to look at whatever they're going for at the time and then price yours according to what the market is saying it's worth right now. These things move a lot. You hear about options traders. We're not talking trading. That's a zero-sum game. That is definitely not conservative, right? So that's not what we're talking. We're talking about selling options to people that buy them so we can generate extra money on our portfolio. Anytime there's an options contract, there has to be 100 shares it involves 100 shares of the underlying stock. So one contract equals 100 shares, which if you're talking Amazon, that's, at 3,000 a share, that's 100 shares. So $300,000, right? So, I mean, they can be big. One contract per 100 shares. and you sell it out of the money, which means at a higher price than the current price. So let's take a stock like G, generic, is not an actual stock, but it's what I will use here. So if the price of G is at $12 right now, you can put a contract out there for say $14 and you pick a date in the future. So go out, say 2 months. So today is the early part of July. So let's go to the early part of August, September. So let's pick September 5th. It's always a Friday, and I'm not looking at my calendar, but whatever that first Friday in September is. And it's for 100 shares. And I write a contract at $14 and somebody buys it off of me. Well, that means I would be happy to sell my shares at $14 a share 2 months down the road. It's at 12 now, generic. In 2 months, if it's over 14, good deal for you. You get my shares at 14, but I'm signing up right now that says, if you pay me some money, I will give you the option to buy those shares from me at $14 2 months from now. Obviously, if the stock's less than $14 at the time, you will not be exercising your option. The option simply expires and goes away, and I keep all the money that you gave me. If, however, the stock goes to $15, I still keep the money you gave me because that's the income that I'm talking about. But now I must give you my shares, my 100 shares at $14 a share because that's the contract giving you the option to buy them. So would I have missed out on some upside? Yes, because they actually went to $15 a share. But I said early July, I'd be happy to sell them at $14 a share. So I'm making money off the options premium, and I'm making money off of the appreciation in the stock, even though it may have gone higher. So you're not being greedy. You're not trying for home runs. You are definitely hitting singles with this strategy. So consider. So we already talked about if the price exceeds the strike price, you sell a position for the profit, and you get to keep the profit. And of course, you keep the premium. Or you roll over the option, which is called rolling out and up. You roll the time out and you roll the price up. So as the stock exceeds $14, say between the time while that option is before it expires, you simply buy that back and issue another option for $16 and a little further out in time. That's how you can roll these options. So again, you'll be collecting a premium to do that. So that's what I do with these, is continue to roll them. I don't have any intent to sell. Sometimes I do. If I'm only holding a position for a short term, I'm like, if somebody can just give me 25 bucks for this, then I'll be happy no matter what the actual price goes to. It's a very not greedy kind of thing. So, or if the option expires, you keep the premium. If the stock price decreases, so say the stock was at 12 and you pay me $1 for my 100 shares, that's $1 per share, so that's 100 bucks. So you give me $100. And I give you the option to buy my shares from me at $14 in early September. That was the example we just talked about. What if the stock between now and then drops to $11? Well, you don't make anything on your option because it's not above 14. So why would you buy at 14? We can go to the open market and buy it on 11. And I will have not lost anything because even though the stock price dropped $1, you gave me $1 per share for the right to buy them at a higher price in the future, which didn't happen. So it offsets the loss. And in my example, it offsets it completely. Obviously, the stock price could have dropped from $12 to $6 during that time, but at least and then it offsets $1 of the drop. So that's a little bit about how it works. Now, as we need insight as to who's buying these things. So when we go to sell our option, there's two people that buy them out there. The first one is speculators. And the second ones are those that are limited with capital. So let's talk about the speculators first. Now, 80% of all options expire worthless. That's kind of a rough wag. That's not always the case. I think the actual number is probably closer to 70%. But we're positive expected value, and we know that greater than 50% for sure of all options expire worthless. So we are happy to sell these things to whoever's buying them. But in the first case, speculators, well, speculators are gamblers. They don't care about positive EV. They'll gladly take a negative EV situation, and options are zero sum, unlike investing, but options are zero sum. So if you give me $100, that I get 100, you don't have 100. I mean, that's exactly how that works. We can't both win in an options scenario. So they believe in possibility over probability, meaning they'll accept a negative expected value for the possibility of making big money. So if they just know Tesla is going to continue to go to 2,000, 3,000, 5,000, why stop there, 50,000? Then they can make an unlimited amount of money, and they're only out what they paid you for that option. So again, they're looking for possibility. You want probability on your side. So then same thing, the lottery ticket math that we just talked about. They know exactly what they're spending. So when you buy a lottery ticket, you are out the $1 or $5 or whatever they cost. I don't know. But whatever you spend, you know for sure you're out that amount. But there is a possibility that you could win millions or mega millions or whatever it is out there. There's that possibility, and that's why you play. You know it's not probable because the math all resides on the house's side, or in the lottery cases, the state side, because that's how they're peeling all that money off to support whatever the state supports with their lotteries. So those are the folks that are buying these things, are speculators. Now, if you have kind of transitioned to the limited capital, if you want to buy a share of Tesla, but you only have $1,000 in your account, and bummer for you, it's $1,200 a share, then you can buy an option for a premium, and you can't afford the stock, but you can buy an option on a share, and it can be a dollar or two above the current price, and you'll pay a hefty premium to do that. But if the stock continues to rocket up, you could have unlimited upside. So it does allow you to participate in stocks that you would not otherwise have the capital to buy. So that's who's buying those options. So when do I use them? Well, you can use them in any situation, but some are down just like any strategy. Sometimes it would be dumb to do it, and sometimes they're better. This is a covered call strategy, so it works best when the overall market is toppy or stagnant. And when you think of that, the overall market is toppy a lot because it keeps going back and hitting new highs. So when a stock market gets rather high, instead of, say it's 100 shares of generic that you have, instead of selling your generic shares, you can simply sell an option against it, a covered call, for a little bit higher, and then whatever you get for that, the premium that comes into you, in effect, reduces your cost basis in that share. So it's kind of like another dividend because it's income, and it's kind of like reducing your cost basis indirectly because you're getting paid for that share of stock without having to sell it. So it can be the overall market is toppy. That's when I would cover several things in a portfolio, or an individual position is toppy, i.e. it runs up 50% in a day. Well, you might just want to sell a covered call because almost the gamblers of the world think that a stock that goes up 50% today will go up 50% tomorrow. It's just how they think. And sometimes they're right, and they're right enough to keep thinking that, right? It's kind of like lottery players. They win often enough to keep thinking about it, to think that they should continue playing. Gamblers, you win off, the casinos let you win often enough to where you can be greedy and think that that's always going to happen until it doesn't, and then you forget that it doesn't, and you go back after the greedy side again. So if you have an individual position or the overall market that has run up big, that's a good time to put a call on it. Or if you have some of the DGI names that we talked about in the last podcast, we didn't talk about names. Well, we did one. We talked about ExxonMobil. ExxonMobil doesn't jump 50% in a day. It also doesn't go down 50% in a day. It's ExxonMobil. So it just kind of trudges along, and it pays a 6 or 7% dividend right now. Of course, that'll change the second I say it right, but it pays a big dividend. So when you buy ExxonMobil, you aren't actually counting on it going much higher. I mean, it'll trickle up over time, but you're counting on that dividend. That's what you want. In addition to that, since it's not moving up and flopping all over the place like a Facebook does, then you can write a covered call if Exxon's at, I'm not looking at the chart. So say it's at 45 and you put a call at 50 going, yeah, I'll go out 2 months and say, if the stock's above $50 between now and 2 months from now, you can have my shares for 50 and you can pay me, I don't know, $150 for that privilege. So you take the money and you put it in your account. You can spend it, you can withdraw it, you can leave it in cash, you can do whatever you want. It becomes cash and it becomes irrelevant to the situation because now you have basically sold somebody that option. You can kind of think of it like a coupon. So if you're a store owner and you give somebody a coupon to buy a gallon of milk for $2, I haven't bought one in probably a year, so it's probably off terribly. But not that we don't drink milk, I just don't do the buying. But you put a coupon out there saying you can have a gallon of milk for $2, and maybe you say limit 2. That's an options contract. If the person who has that coupon, they didn't pay anything for it, but if they get off of their couch and they go to the store, then they have the option to buy it for that. If they look down and the milk's $1.79, well, they'll just buy it for $1.79 or not buy it at all. If it's $2.50, then they can choose to buy it or not. And then if they choose to buy it, they could turn around and sell the milk if they want. Most people, I don't think, would do that, but you could and make that into an arbitrage. But that's not really what we're talking about here. We're talking about the DGI names that kind of trade sideways over time. So if it has a large dividend, so if you pay out 7% over time, well, if the stock price stays even, you've made 7% a year, which is a darn good return, right? The aggressive market average 10 to 12%, more of a conservative, moderate type strategy, 6 to 8%. So you're kind of right in the heart of that. So if income generation or capital preservation is your primary goal, the dividend growth investing strategy, which brings in about 4 to 5% in dividend, plus if you sell calls every couple months or so, you can generate another 1 to 2%, and you add those together and you get that 6% plus of income, and that's without the stock moving up or down. So it's independent of what the stock's doing. In the last episode, we talked about the cow and living off the milk. You don't care what the price of the cow, the decline in beef price or whatever, you don't really care what the cow's doing. You're living off the milk, which a lot of people find this very attractive. Well, this is just extra milk when you use covered calls. So I told you there would be math. So if you have the chance, assuming you're not driving, you can pull out a piece of paper if you choose, or you can go to YouTube to follow on with the slide. That you can only write calls when only write the calls. This is strategy now. When the contract can generate 1% per transaction. It's just not really, there are some fees associated, trading's mostly free now. There are some smaller fees associated with options contracts. They're in the pennies. You kind of don't have to worry about them because they're literally just a minor friction compared to overall investing. But generally you want to do the math ahead of time to make sure you can generate 1%. You pick a strike price and an expiration date that meets that 1% criteria. And if you could use TD Ameritrade, they have Thinkorswim. You can go on to Schwab's platform. Whoever you use has a platform that helps you figure this out, so you don't have to figure it out on your own. It's more art than science, though, and there's very specific skill sets to do this. I'm going to tell you how I do it. If you have another program plan, that's then good for you. But whatever you agree to, you have to be happy taking the combination of collecting the premium along with the capital appreciation. If it would keep you up at night, if your shares of generic were at $12 and you said I'd sell them to you in 2 months at 14 and the stock goes to 15 or 50, if you're not ever going to sleep again over that, then don't do this. It's not for you. Then don't mess with it at all. But you also have some relationship issues with money if that's the case, because you're also pretty greedy. So this is a way, again, just to string out singles over time and collect all of this. So let's talk about a specific example. Say you hold 500 shares of generic, which is ticker symbol G, that's made up, at a current price of $13.45. So that math works out to $6,700 or so. Now we have 500 shares, so we can sell 5 calls. Remember, it's 1 call per 100. So we can sell 5 calls at the $15 strike price. Remember, we're at $13.45 now, so that's $1.55 above where we are. So 12% move up in the stock, and with an expiration date 4 months out. And we sell these for 24 cents each. So 24 cents each is actually $24 each. So 5 times that takes us up to $1.20. Subtract out any commissions. Say I don't know, there's $13 in commissions. It won't be that much anymore. But if it was, then it would take us down to $106 net profit, which is a 1.6% gain over 4 months. Since it's over 4 months, we could obviously do this 3 times a year. So 3 times that would be around 4.5%. So if we're assigned, if the stock price goes greater than 15 of G, which is now 13.45, we get to keep the $1.55 per share. So times 500, which is $775, which is 11.5%. So the option's given us 1.6%, and we keep that no matter what. If we get assigned, meaning it actually goes above the strike price that we agreed to, we've still made 11.5%. You cannot complain about that. And this is in 4 months. You extrapolate that over a year and you have to multiply it by 3. If G pays a 4% annual dividend and it pays quarterly, well, during this 3-month period, you're getting at least 1% dividend, maybe 2, depending on how your things align, and the expiration dates do align around dividends. So that's another percent on top. So you're looking to hit singles and collect the percentages. Hopefully you could follow that math along. So in conclusion, if you understand options, you'll find they aren't nearly as risky as what you will say. Now, you will have to sign an options agreement with your custodian, and you'll have to say either do or don't have experience. But covered calls are the basic level of option because it's simple. You already own the shares. You're simply selling an option above that, and you're not buying options, you're just selling them. And again, you're looking for those singles, which is why it marries nicely with a buy and hold type philosophy, as well as a dividend growth philosophy. If you are out there and you are 25 years old and you buy 100 shares of, say, Apple, and 40 years later, you're at 65 and Apple has run up, several $1,000%, and you think it's overvalued. If you have that in a taxable account, you'll run into a situation where you literally can't sell. People are like, what? Yeah, you can't sell. I hope you've had this problem. It's a good problem to have, and it is a first world problem. But faux show, if you can, your stock positions in a taxable account can run up so much that if you sold them, you would be stuck with a huge tax bill that would, and it's like, no. And again, of course, the way tax law is currently written is if you pass away, your stock passes on with an updated cost basis. So you don't have to pay taxes on all that appreciation. So you can find yourself in a situation where if you've had something for a long time, you kind of can't sell it, but it does run up too much. How do I continue to make money off of it? Well, 2 ways. You do it off the dividend, you do it off of covered calls, and you keep stuff covered forever. Once you've had a stock for 20, 30 years, you might as well just cover it up because you're not going to sell it. And if it reaches the strike price before the expiration, you simply roll that call out into the future. So that's what you need to know about the covered calls. That's all we have for today. Please reach out through OTOTnow.com if you have any questions or comments. Thanks again for listening, and here's to you fighting the good fight every day to be on time, on target with your goals.